Look at this signal from the system, not the headlines. From October 25th, 2022 until December 13th, 2024, 3-month Treasury bills yielded more than 10-year notes, then finally flipped back. That was the longest 10-year minus 3-month inversion in roughly 45 years. The result? A textbook uninversion, right as unemployment drifts higher and growth starts to cool, while major stock indices still hover near records. This time is not different. It only looks calm before the system quiet, then snap phase shows up. Watch what that combination usually means. When the yield curve, the relationship between short and long interest rates, turns negative for years, then steepens again, history does not call it a victory lap. In the 1970s, in 2000, and in 2008, the same pattern showed up before recessions and deep bear markets. One after another, the curve stopped being upside down only once the damage was already working through balance sheets. So what exactly is the present uninversion really flagging now? Watch what the curve is actually measuring. The 10-year minus 3-month spread takes the 10-year Treasury yield and subtracts the 3-month Treasury yield. The 3-month tracks the Federal Reserve's policy rate almost 1-for-1. The 10-year reflects the market's view of the so-called neutral rate, the interest rate that neither stimulates nor breaks the economy. When the Fed's short rate sits below that neutral line, monetary policy, the way the Fed manages money and rates, is loose. When the Fed jams its rate above that neutral line, policy turns tight and growth slows. Check how the mechanism works in plain steps. First, the Fed lifts short rates above the neutral rate. Then the yield curve inverts. Banks borrow short and lend long, so their core spread, the gap between their funding cost and lending rate, gets squeezed. Credit creation cools. After enough time, hiring slows and investment decisions get postponed. Finally, the Fed blinks and starts cutting, or at least signals cuts. That is often when the curve uninverts because short yields fall faster than long yields. The damage, however, is already inside the system. So far, the yield curve is a timing tool, not a magic trick. Coming up, why past uninversions lined up with real recessions? Look at the historical pattern. In 1928 and 1929, the curve inverted, then steepened again right before the stock market peak on October 29, 1929. The crash that followed erased roughly 80% of US equity value over 3 years. In the late 1970s, similar inversions and uninversions preceded recessions alongside oil shocks and inflation spikes. In 2000, the curve normalized just as the dot-com bubble burst, leading to roughly a 50% drawdown in broad US equities over the next couple of years. Watch how it repeated in the 2000s. In 2006 and 2007, the 10-year minus 3-month spread went negative again, then crawled back above zero just as mortgage credit started to crack. By late 2008, equities had fallen about 60% from their peak. The pattern showed up early in every modern downturn. That does not mean the curve caused the recessions. It means policy had been tight for long enough that the system could not absorb another shock. Why would a simple line on a chart line up with so many breaks? The mechanism works like this. An inverted curve says short-term money is expensive relative to long-term money. That hurts leveraged players who borrow overnight and hold longer assets. Banks, hedge funds, and shadow lenders juggle that cost for a while. When the curve steepens again, it is rarely because growth suddenly improved. It is usually because the Fed cuts into weakness, and long yields follow slowing growth lower. Translation: by the time the curve looks normal, the economy is already abnormal underneath. Picture this for a second. It is like driving with the brake pressed halfway for 2 years, then easing off the pedal right as the engine starts to sputter. The moment the car feels smoother is often the moment the damage to the engine becomes obvious. That is the quiet surface, then snap behaviour the system keeps repeating. So far, every major recession since the 1960s has had this inversion, then uninversion sequence. Coming up, what is truly different and what is not about the 2025 version? Check the strange twist this time. From October 25, 2022 until mid-December 2024, the 3-month yield sat above the 10-year. Then the spread finally pushed back into positive territory as the Fed signaled the end of its hiking cycle. But by late November 2025, the 10-year yield still hovers around 4.04%, near its long-run average, rather than in a deep slide. Short rates sit in the low 4% range after earlier cuts. The signal was hiding in plain sight for 2 full years. Look at what that implies. In earlier cycles, the 10-year yield fell hard into the uninversion as markets priced weaker growth and aggressive rate cuts. Today, long yields are not collapsing. Real yield, the interest rate minus inflation, remains positive, with consumer price inflation running near 3% year-over-year as of late October 2025. That means investors still demand solid compensation to hold longer bonds. Translation: the bond market is not yet pricing an imminent deep recession. Why does that matter for the "this time is different" story? Now the pressure builds in the labour data. The unemployment rate has edged up toward the mid-4% range in recent months, its highest level in several years. Payroll gains slowed and became choppier through 2025, with revisions often subtracting earlier reported jobs. That is not a collapse. It is a soft turning point. Late cycle slowdowns often start with small moves in unemployment, not sudden spikes. System quiet, then snap tends to begin with that slight upward curl in joblessness. Not a headline shock. Think of it like a small crack in a bridge. Traffic still flows. The structure still looks strong. The crack only matters when more weight and time hit the same weak spot. The yield curve uninversion and the unemployment drift are that weak spot forming together. So far, long yields are steady, short rates have eased, and unemployment is rising gently. Coming up, why the calendar now matters as much as the curve. Watch the timing from here. 3 dates decide the next move. December 17, 2025, brings the employment report for November. December 18, 2025, brings the next consumer price index release. Then January 27 to 28, 2026 brings the first Federal Open Market Committee meeting of the new year. Those 3 events link jobs, inflation, and policy into one chain. The result? A visible test of whether the Fed sees a soft landing or something harsher forming. Check this contradiction around those dates. I'd say, if unemployment keeps trending higher while inflation stays near 3%, the Fed faces a harder trade-off. Cutting too fast risks re-accelerating prices. Cutting too slowly risks turning a gentle slowdown into a sharper break. The math does not lie. Debt across the US government, corporate sector, and households still costs more to roll than in the easy money years. Follow the money on this steepening, and the story sharpens. The mechanism works like a credit card reset. For years, the system borrowed at very low rates. Now, as bonds mature, they roll into coupons, the fixed interest rates on bonds, set near today's levels. Even if the Fed trims short rates a little, the average cost of debt stays elevated for a while. It is like a household that refinances a mortgage at double the old rate. The payment shock does not destroy the budget overnight. It just quietly eats more cash every month until something gives. So far, the curve says tight money already bit, while the calendar will show how deep the bite goes. Coming up, who stands on each side of this not different argument? Look at the main players. The Federal Reserve wants inflation back near its 2% target without triggering a spike in unemployment. The US Treasury must refinance and issue trillions in debt while keeping auctions running smoothly. Global investors, from European central bank area banks to Asian reserve managers, choose how much US duration risk they are willing to hold. Each group reads the same curve but with different incentives and constraints. Watch how their actions line up. If Treasury auctions remain firm, with no big auction tail, weak demand that forces higher yields to clear sales, then markets will read that as stable demand for US debt. If foreign buyers step back and primary dealers, the banks required to bid at Treasury auctions, have to warehouse more bonds, yields may rise even as the curve steepens. Notice the contradiction. Bonds can flash stress, while economic data still look acceptable. Picture the system as a crowded exit door. As long as only a few people leave at once, the door works fine. If a rumour starts and too many people move at the same time, the same door becomes a bottleneck. In markets, that rumour can be a hot inflation print, a weak jobs report, or a messy auction. The curve's uninversion says the crowd is now close to that door. Now comes the cliffhanger. If the December 18 inflation report lands well above 3% again, and if unemployment keeps drifting higher into that January Fed meeting, the snap seen in recent yield moves will not be the last. That is the scenario where the Fed's room for gentle cuts shrinks, and markets must reprice both growth and policy at once. The pattern is not identical to 1929 or 2008, but the rhyme is hard to miss. So far, the Fed, Treasury, and global investors are all walking a narrow path between inflation and growth. Coming up, the 3 warning signs that separate soft landing from hard reset in this cycle. Check what "this time is not different" really means. It does not mean the same crisis will repeat with the same trigger. Technology, politics, and global capital flows have changed. It means the core mechanics of long tightening cycles have not changed. Long periods of high real yields, long periods of inverted curves, and rising unemployment have always put pressure on leveraged structures. System quiet, then snap remains the recurring motif, even if the script around it looks new. The pattern emerged across a century. In 1929, the snap came through equity margins and bank runs. In the 1970s, it came through inflation and oil shocks. In 2000, it came through technology valuations. In 2008, it came through housing and structured credit. Today, the pressure may show through private credit, commercial real estate, or parts of the sovereign debt complex. The exact crack can change. The combination of tight money and weakening growth does not. Think of it as a recurring equation. High real yields plus rising unemployment plus long inversion periods equal elevated recession risk. The curve's uninversion signals that the equation has moved into its later stage. The system might still glide through with only a shallow slowdown, but history suggests that betting on a painless outcome after such a long inversion is the purest version of "this time is different." Now watch the final scoreboard. 3 warning signs decide whether this stays a soft landing or becomes a hard reset. First warning sign: the speed of steepening. If the 10-year minus 3-month spread widens because short rates fall a little, that is one story. If it widens because long yields jump while auctions struggle, that is another. That second version tightens financial conditions again and strains balance sheets. Second warning sign: the unemployment path. If joblessness holds near the mid 4% range and then stabilises, the system can absorb it. If it climbs toward 5% or higher while hours and wages weaken, household cash flow erodes. That is when defaults rise and credit losses start to spread. Third warning sign: the policy and data calendar. If December and early 2026 inflation prints drift lower while growth cools, the Fed can cut without appearing behind the curve. If inflation re-accelerates into those meetings while unemployment rises, the Fed's constraint becomes obvious. That is when markets may realise the curve's uninversion was not a mission accomplished banner. It was a late cycle flare in a long tightening campaign. The result? Auctions, firm or soft. Real yields, rising or falling. Central bank flows, adding or pausing. Look at those 3 lines over the coming months, and the message becomes clear. The shape of the yield curve says policy has already walked far into restrictive territory. The quiet now does not prove that this time is different. It just shows how calm the system can look right before the next snap.